When a news anchor announces, "The market is up 500 points today," they are almost always talking about the Dow Jones Industrial Average. It is the most quoted, most famous stock market index in the world. And yet, virtually no serious financial professional uses it as a benchmark. In fact, its entire construction is based on a mathematical anachronism that makes it, arguably, the least representative major index in modern finance. In the next 10 minutes, you will understand exactly what the Dow Jones is, how its archaic price-weighting system creates a distorted view of the market, and why the S&P 500 replaced it as the true benchmark for the US economy, a critical distinction for building your investment portfolio. The Dow Jones Industrial Average, or DJIA, is the second oldest stock market index in the United States, created in 1896 by Charles Dow. It is a simple list of just 30 large, well-established, blue-chip American companies. These companies are not chosen by a quantitative rule, but by a committee at S&P Dow Jones Indices, who select firms that have a stellar reputation and are believed to be representative of the broader economy. Its original purpose was to be a simple, easy-to-calculate proxy for the health of America's emerging industrial economy. The first-ever Dow consisted of 12 companies, titans of industry like American Tobacco, U.S. Leather, and a company you may have heard of, General Electric. Of those original 12, General Electric was the last to be removed in 2018 after 122 years. Today, the Dow's role is primarily as a media headline. Its small number of components and its unique and, frankly, bizarre calculation method make it a poor substitute for broader indices. The Dow's fame is undeniable, but its relevance is highly debatable. The source of this debate is its unique and deeply flawed construction, a system called price weighting. How does this system work, and why does it produce such a distorted picture of the market? This is the single most important concept you must understand to see why the Dow is so flawed. It all comes down to price weighting versus market cap weighting. Theory: two different systems. The S&P 500, the modern standard, is market cap weighted. A company's influence on the index is determined by its total market value, share price multiplied by the number of shares. This is logical. Larger, more valuable companies have a greater impact. The Dow Jones Industrial Average is price-weighted. Its value is calculated by adding up the share prices of its 30 companies and dividing that sum by a special number called the Dow divisor. This means a company's influence on the index is determined solely by its share price. A company with a high stock price has more influence than a company with a low stock price, regardless of their actual size. Analogy: the basketball team's average. Imagine you're trying to determine the most important player on a basketball team. The S&P 500's method is like looking at the player's performance statistics: points per game, rebounds, assists. The player with the best stats is the most valuable. This is rational. The Dow's method is like deciding the most important player is the one with the highest jersey number. A player wearing jersey 99 would have a massive impact on the team's average, while the superstar wearing 2023 would have far less impact, simply because their jersey number is lower. A company's share price is just a jersey number. It's an arbitrary figure that a company can change at any time with a stock split. It has no bearing on the company's actual size, profitability, or importance to the economy. Example: the distortion in action. Let's look at two real companies currently in the Dow. UnitedHealth Group, UNH, has a share price of roughly $500 and a total market value of about $450 billion. Apple, AAPL, due to past stock splits, has a share price of roughly $200, but a total market value of over $3 trillion. In the logical, market cap-weighted S&P 500, Apple is rightly one of the most influential components, with a weight many times greater than UnitedHealth. but in the bizarre price-weighted Dow, UnitedHealth, with its high $500 share price, has more than double the influence on the index's daily point movement than Apple does. A $10 move in UnitedHealth stock moves the Dow more than a $10 move in Apple stock, even though Apple is a vastly larger and more significant company. This is why no serious financial advisor uses the Dow for sophisticated portfolio construction or wealth management. Because of its fame, the Dow is a source of two persistent rookie mistakes. Pitfall number 1, confusing points with percentages. The media loves dramatic headlines. The Dow plunges 500 points. This is meaningless without context. When the Dow is at 40,000, a 500-point drop is a trivial 1.25% move. When the Dow was at 10,000 in 2009, a 500-point drop was a 5% crash. Always look at the percentage change, not the headline-grabbing point value. Pitfall. Number 2. The industrial misnomer. The name Industrial Average is a 129-year-old historical artifact. The index today is dominated by companies in technology, healthcare, and financial services. It is simply a collection of 30 blue-chip firms, not a barometer of American industry. Avoiding these common misunderstandings is crucial. But is there any value left in the Dow at all? The answer is yes, if you know where to look. The advanced strategy, Dow theory. The Dow's real value today is not as a standalone index, but as one half of a century-old market timing framework called Dow theory. Charles Dow created two original indexes, the Industrials, the DJIA, and the Rail Average, and now called the Dow Jones Transportation Average, DJIA, which tracks 20 of the most important shipping, airline, and logistics companies. Dow theory states that for a major market trend to be confirmed as healthy, the two averages must move in the same direction. The logic: the industrial companies produce the goods, and the transportation companies ship those goods to market. If the industrials are rallying, signaling that companies are making more stuff, but the transports are falling, signaling that less stuff is actually being moved, it's a bearish divergence. It suggests the economic strength powering the industrials' rally might be an illusion. Professionals and market technicians watch this relationship closely. A divergence between the two can act as an early warning sign that a market trend is losing its underlying momentum. The true value of the Dow for a sophisticated analyst lies not in its point value, but in its relationship to the companies that move the physical economy. Let's distill this into the three essential truths about the Dow Jones Industrial Average. It is a famous but flawed index. The Dow consists of just 30 committee-selected blue-chip companies, making it a narrow and subjective snapshot of the market. Price weighting is its fatal flaw. Its archaic price-weighted construction means a company's influence is based on its arbitrary share price, not its actual economic size. This gives a distorted view compared to the superior, market cap-weighted S&P 500. Its true value lies in Dow theory. The advanced use of the DJIA is not as a standalone indicator, but as part of Dow theory, where its trend is compared with the Dow Jones Transportation Average to gauge the true health of the market and the economy. The Dow Jones is the most famous number in finance, but as an intelligent investor, you must understand that it is a headline, not the whole story. If this analysis provided you with real value, invest a single click in the subscribe button to get daily access to the Codex. Knowledge is the new capital. We'll see you tomorrow.